So far in this chapter, we've discussed consumer surplus, the difference between the consumer's highest willingness to pay and what they actually have to pay, and producer's surplus, the difference between the producer's lowest willingness to sell and what they actually sell for. And then we talked about how economists use that, the sum of all the surplus in a market, to measure market efficiency. And we made the argument that a market is most efficient, welfare or surplus is maximized when the market is allowed to do what the market does naturally and go to the market equilibrium price and quantity, that price that makes quantity supplied equal to quantity demanded. The market is most efficient when it is not interfered with by anyone from the outside, specifically government. So now let's turn to what happens to that efficiency when there is some government interference in the market. Specifically, let's think about taxes. This is one of the more common ways that a government may interfere, may cause some changes in a market. So let's suppose the government imposes an excise tax on milk. So an excise tax is just a particular type of tax where there's a special tax on a product. So we know of excise taxes in the case of, say, gasoline or cigarettes, items that have their own special tax on them. So let's suppose there's an excise tax on milk. Who pays for the tax? Well, who actually pays out of pocket, it depends on how the government writes the law, right? They could write a law that says that for every gallon of milk you buy, you must send the government $1. In that case, the consumer is paying the tax out of their pocket. Or the government could write a law that says for every gallon of milk you produce, you must send $1 to the government. In that case, the producer is paying the tax out of pocket, right? They're the one who actually has to cut the check to the government. But as we will see, the tax incidence, or the burden of the taxation on the party who pays the tax through higher prices or lower quantities sold, which comes with higher prices, will occur regardless of whom the tax is levied on. In other words, even if the government levies the tax on buyers and says for every gallon of milk you buy, you must send $1 to the government, the producer is going to feel some of that tax. And even if the government levies the tax on the producer and says for every gallon of milk you produce, you have to send the government $1, the consumer is going to feel some of that tax because prices will be higher for them, right? That is the tax incidence. It's not who pays the tax out of their pocket, but it's who actually bears the burden of the tax, who actually pays the tax. And the answer to that is that regardless of whom the tax is levied on, we have the same tax incidence of the buyer or the seller having to pay for the tax. So let's look at how it all works out using a supply and demand model. So here's a market for milk, right? And without any intervention, without any changes, the market price for milk is $4. And when a consumer walks into the store, they pay $4 for a gallon of milk, and at the same time, the producer receives $4 for a gallon of milk, right? Let's assume that the government now levies a tax on the consumers of $1 per gallon of milk. The result of that is that demand for milk will shift to the left. Because now that you know, so your original demand curve gave us really your willingness to pay for milk, right? But now that you know you're going to go into the store and buy milk and then also have to send $1 to the government, your willingness to pay as far as the sticker price on that milk, goes down, right? So you will buy less milk at each price, knowing that after you buy it, you're going to have to send the government $1, right? And in fact, the demand curve shifts in a very specific way. It shifts by the amount of the tax. So in the past, we've talked about considering these shifts to be left or right, and it still is a leftward shift, but in fact, in this case, when the case of a tax, the demand curve actually shifts down exactly by the amount of the tax. So the distance from this demand curve to this demand curve is exactly $1, the amount of the tax, right? So what is the result when the demand curve shifts down after a tax? The result is we have a new market equilibrium here, right? The new market equilibrium tells us the sticker price on the milk. When you walk into the supermarket, the price that you see written on the milk is the equilibrium price, right? So it used to be $4. You paid $4. The producer received $4. Now the sticker price has gone down to this new equilibrium price, right? In this case, it's $3.50. All right, this is just an example. These numbers are just example numbers. So in this case, the new sticker price is whatever the new intersection of that supply curve and your new demand curve is. That's the sticker price on a gallon of milk. Now, how much does the consumer actually pay for their gallon of milk? They'll pay the sticker price, $3.50, but then they also have to send $1 to the government. Remember, that's the tax that's levied on the consumer. So the price the buyers actually pay for milk in this case is the $3.50 in the store sticker price plus the $1 to the government. So the buyers actually pay $4.50 for a gallon of milk. What is the price the sellers receive? It's the $3.50, right? Because the sellers don't have to send any to the government because of the way the law was written. The consumers are the ones, the buyers are the ones who have to pay the government. So the seller, once they receive that $3.50 from the sticker price in the store, that's what they receive. That's the end of the transaction for them. So $3.50 is what the sellers receive, $4.50 is what the buyers pay. So there's a difference of $1 between what the sellers receive every time there's a milk transaction and what the buyers pay every time there's a milk transaction. That $1 is the tax. That difference is the tax, right? So who paid for the tax? Who bore the tax incidence? Well, we know the consumer is the one who pays out of pocket. They're the ones who have to send the $1 to the government. How would I know that if it hadn't been told to me? You know that because you saw the demand curve shift. When the demand curve shifted, that indicated that it was the consumer who was having to pay, the demand side that was having to pay. So we know that the consumer is the one paying out of pocket, but who bears the tax incidence? The answer is both do, right? Because prior to the tax, the consumer was only paying $4 for a gallon of milk. Now they're paying $4.50. The consumer's paying more for milk than they used to. But also, the seller is receiving less for a gallon of milk than they used to, right? Prior to the tax, when the consumer paid $4, all of that $4 went straight to the seller. Now the seller is, because of a decrease in demand, we've got a lower price on milk on the shelf, so the seller is receiving less per gallon of milk than they used to. So even though the buyer is the one paying out of pocket here for the tax, the seller is bearing some of the tax incidence. The seller is ending up paying for the tax in a sense, at least part of it. On the other hand, the same tax could have been levied on sellers. So if the government says for every gallon of milk that you produce, you have to give us $1. The tax is on the seller. That would shift the supply curve because it's essentially an added cost of production, right? So we see the supply curve shift to the left. It shifts to the left a very specific amount. It shifts by the amount of the tax. So the distance between this supply curve and that supply curve is exactly $1, or the amount of the tax, right? What is the result? The result is a new equilibrium. The place where the demand curve and the new supply curve cross is the new sticker price of milk. The new sticker price of milk is $4.50. And that is the price that buyers pay, because now, remember, it's the seller who has to send the dollar to the government. So once the buyer walks into the grocery store, they pay their $4.50 for a gallon of milk, they're done. They paid $4.50. Because of the decrease in supply, the price has gone up. The buyer pays $4.50 for a gallon of milk. How much does the seller receive, however, for each gallon of milk? They get that $4.50, but then they have to send a dollar to the government. So for each gallon of milk that they sell, they really only get to keep $3.50. So again, there's that dollar difference, the amount of the tax, between what the buyers pay and what the sellers receive. And in this case, the government levied the tax on the sellers, but we see that even though the seller is the one paying the tax out of pocket, the buyer also bears part of the tax incidence, through increased prices. So regardless of whom the tax is levied on, if it's levied on consumers, some of the burden is passed on to producers because of the falling market price, because of the decreased demand. If the tax is levied on a business, the firm attempts to raise prices to pass some of the burden on to the consumers. And in the end, it doesn't matter who the government levies the tax on, the incidence will be the same. Now, in the example that we've just looked at, the incidence was the same in the sense that it was symmetrical. The consumer paid half and the firm paid half. That will not always be the case. Sometimes the consumer will pay 75% and the firm will pay 25%, or vice versa, right? All of that depends on elasticity, which side of the market is willing to pay more of the tax, right? And that's an elasticity story. But the point that we're making here is that if, when the tax is levied on consumers, that split is 75-25, then the exact same tax levied on the business would result in exactly the same split of 75-25, right? It's not always 50-50, but whatever the split is of who bears the burden, it's going to be exactly the same whether the tax is levied on the consumer or on the business. So far, we've shown that a tax hurts buyers and sellers. Buyers pay a higher price, sellers receive a lower price. What have we not discussed? What have we missed in our discussion? We've talked about how the price is affected. What we haven't discussed is how the quantity sold is affected. So when there's a decrease in economic activity caused by market distortions, or distortion is just a word for someone interfering with the market, right? So a tax, for example, is a market distortion, something interfering with what the market would naturally do. And when there's a decrease in economic activity, or a decrease in transactions, or a decrease in quantity bought and sold, we see what we call deadweight loss, right? Let's illustrate that on a graph. So here's the graph of what happens in the market when there's a $1 tax levied on buyers for a gallon of milk, right? So we've discussed how price changes, right? So we see that we get a new market equilibrium, new sticker price. It causes this gap between the price buyers pay and the price the sellers receive. What else happened, though? Not just the price changed, but the quantity sold moved from E1 to E2, moved from 1,000 gallons of milk back to 750 gallons of milk. When that occurs, we lose surplus. So if you look at this graph and take away this new demand curve, you can imagine our two surplus triangles, right? You'd have the consumer surplus triangle up here, the producer surplus triangle down here. What we've done with the tax is essentially stop the market short. We've imposed a tax which is going to reduce the number of transactions that are made, which reduces the amount of surplus in the market by exactly this triangle. And we call that triangle deadweight loss. It's the lost surplus, the lost welfare due to a change in the number of transactions that's occurring in the market.